then we can kind of take it from there. So a structured product is what the name would be implied is a structured income that has an underlying investment. So for example, it's a CD or a bond that instead of you paying interest like you would get at the bank, it pays you based off of an underlying asset, which could be an index like the S&P 500. It could be gold. It could be a basket of stocks. It could be anything you want. It's structured to give you a particular payout. So for example, a very bare bones basic structured product might be something that is principally protected. So in order to walk you through this, like a CD, it will have a maturity. And let's just say the structured product is a 5-year maturity. And if you were to go to a bank and get a CD, maybe you'd get a couple percent for that CD. But if this structured product was linked to the S&P 500 and it were principally protected, what happens is in 5 years, you look at how the S&P is done. If the S&P is up, you get the returns of the S&P, or sometimes actually even a little bit more. If the S&P is down, which it's down about 20% of the time in any 5-year window, your principal is protected, so you get your money back. So it's a way to participate in the upside of the market and not take any risk.
Okay.
So it's a very bare bones basic version. Now, a structured product term is a catch-all for all sorts of different structures. So that one was principally protected. You could have things with just some protection, maybe 10, 15, 20% protection to the downside. You can actually have capped upsides, but accelerated returns. They get all sorts of complicated. So you generally, the reason why they weren't very popular or haven't been very popular in the retail market is because they're hard to analyze sometimes. They get to be complicated. And frankly, a lot of retail advisors don't either have the patience or the tools to analyze these structured products. But it's a $4 trillion marketplace. They're mostly used by institutional level investors who have the capabilities and the technologies to analyze these products. Now, Kruse Asset Management, we're a quantitative investment firm, so we're comfortable with the analytics, but we've partnered with a company called Halo Investments, which is out of Chicago, and their goal and their mission is to democratize structured products for the retail investor. So we can create our own structured products on the fly using artificial intelligence and bid them out to the banks. So it's a great asset class to help reduce risk for people that maybe don't want the risk, but also want the upside reward.
I was going to ask a question here. Would you say sort of comparable to the index product?
You mean like an index variable annuity?
Yeah, index annuity or index, any kind of index product.
Yeah, so typically an index annuity or some sort of index product will give you a lesser version of that return. So for example, if it's indexed to the S&P 500, you might get a percentage, 60%, 80%, 50% of that S&P. For structured products, you usually get actually a leveraged upside. So for example, we just created a product that we put all our clients in that had 30% downside protection. Now, keep in mind, the S&P in a 5-year window has only been down one time more than 30% over the last 50 years. So the odds of this negative occurrence happening are really small, but on the upside, you had leverage return of 118%. So you actually got a greater upside return than you would had you just invested in the S&P, where these index products tend to be indexed and get you a fraction of the return, half of that return.
Wow, that's a big difference.
Huge difference, and compound it. And so compound it over your life, what you want to do is you want to take calculated bets. Like if you said, I wanted to put $100,000 to work, I wouldn't suggest you taking $100,000